It happened without headlines, and that's exactly why it matters. Industrial demand for silver reached record levels. Solar installations surged. Electric vehicles multiplied. Electronics became more complex, not simpler, and yet silver barely moved. No breakout, no panic, no rush. That silence is the story. Because in any normal market, rising demand paired with tightening supply forces price to react. That's how commodities work. That's how incentives balance. Except silver doesn't behave like a normal commodity. And it never has. To understand why silver can move from boring to unthinkable faster than almost any asset on Earth, you have to start with what silver actually is. Not what people call it. What it does, gold is hoarded, silver is consumed. That single difference changes everything. Nearly all the gold ever mined still exists somewhere. Bars, coins, vaults, jewelry. It moves from hand to hand, country to country, but it remains. Silver is used altered, dispersed, embedded. Once it's inside a solar panel, a circuit board, a medical device, it doesn't come back, as recovering it often costs more than mining new metal. So while gold piles up over centuries, silver quietly disappears. This creates a paradox that most people never notice. Silver is money, and it's raw material. It sits in two worlds at once. That dual role is why its price behaves strangely. It isn't driven purely by fear, like gold, and it isn't driven purely by growth, like copper. It's driven by necessity. But necessity doesn't scream. It accumulates pressure. Now look at where silver goes today. Solar panels are one of the fastest growing uses of silver. Each panel requires silver for conductivity. As solar capacity expands globally, silver demand rises with it, mechanically, regardless of price. Electric vehicles use more silver than internal combustion cars. Not because of luxury, but because electronics demand it. Power, management, sensors, connectivity, all silver dependent. Electronics overall keep getting denser. Smaller devices, more functionality, higher conductivity requirements. Silver remains the most efficient conductor available at scale. Medical applications consume silver for its antimicrobial properties. That demand doesn't fluctuate with markets. It follows healthcare needs. Defense and aerospace rely on silver for reliability. In those sectors, cost is irrelevant compared to performance. Add it all up and something becomes obvious. Silver demand isn't speculative. It's embedded. Now step back and ask a simple question. If silver is being consumed every year, where is the stockpile that balances that consumption? Most people assume it exists. They'd imagine warehouses full of silver waiting to be released. It's also outdated. Above-ground silver inventories are far smaller than most people think. Unlike gold, there is no massive, centralized hoard backing the market. Much of the silver mined in the past century is gone, used, scattered, uneconomical to recover. So how does the market function as if supply is abundant? The answer sits in the pricing mechanism itself. Silver's price is not primarily set by people demanding physical metal. It's set by paper, contracts, derivatives, promises of future delivery. On paper, silver is plentiful. On the ground, it's constrained. This disconnect can persist for a long time. Decades, even. As long as confidence holds and delivery isn't challenged, paper pricing works. That's why silver feels stable when it shouldn't. But stability here doesn't mean balance. It means postponement. Now look at history. Silver doesn't trend upward smoothly. It doesn't behave politely. When pressure builds, it releases violently. Short bursts, sharp spikes, sudden... This isn't theory. It's pattern. And every time it happens, people say it came out of nowhere. It didn't. They just weren't watching the right signals. Now let's address the number that makes people uncomfortable. $200. It sounds absurd if you anchor to recent prices. It sounds extreme if you compare it to today. It stops sounding extreme when you change the frame. Adjusted for inflation, silver has already traded far higher than current levels. In real purchasing power terms, today's price is historically low, not high. Then look at the gold to silver ratio. For long stretches of history, silver traded at roughly 15 to 20 ounces per ounce of gold. Today, that ratio is often 4 or 5 times wider. That divergence doesn't require perfection to correct. It requires stress, and stress doesn't announce itself early. Now think about market size. Silver is a small market. That matters. It doesn't take trillions of dollars to reprice silver. It takes a relatively small amount of capital arriving at the wrong moment when physical availability is tight. A few large buyers demanding delivery instead of settlement. A few industrial users securing long-term supply, a few governments prioritizing stockpiles. Silver doesn't need everyone to change their minds. It needs a handful of players to act out of necessity. That's why moves are fast when they come. Now look at how different participants behave. Industrial buyers don't speculate. They secure supply. If price rises, they pay. Production depends on it. Investors, on the other hand, wait. They watch price. They look for confirmation. That creates a lag. Industry moves first. Price follows. Investors chase last. That sequence matters. Now, think about how you approach this. You didn't wait for silver to trend. You noticed that consumption was rising while inventories weren't. You noticed that silver was treated as abundant in markets, but scarce in practice. You paid attention to where silver was being used, not how it was being talked about. That changed your patience. You weren't early in calendar time. You were early in understanding. That's why volatility didn't shake you. Because you weren't watching price alone. You were watching pressure, and pressure builds quietly. In the next part, we're going to move deeper into how paper pricing holds silver in place, why that system works until it doesn't, and what specifically causes the break. Because silver doesn't drift into new regimes. It snaps into them. Like, subscribe, and let's continue. Once you accept that silver is being consumed faster than it's replaced, the next question becomes unavoidable. If physical silver is scarce, why does the price behave as if it isn't? The answer lives in the gap between what exists and what is promised. Silver is priced mostly through contracts, not bars. Futures markets allow massive volumes of silver to be bought and sold without anyone touching the metal itself. These contracts were designed to help producers and users manage risk. Over time, they became the primary mechanism of price discovery. That shift matters because contracts can be created far more easily than silver can be mined. Paper expands, metal does not. As long as most participants settle in cash instead of demanding delivery, the system functions smoothly. Prices remain calm. Liquidity appears abundant. Scarcity stays invisible. This works until it doesn't. And history shows that when confidence cracks, it cracks suddenly. Now think about how little silver it actually changes hands physically each year. Mining output is relatively flat. New discoveries are rare. Grades decline. Costs rise. Recycling exists, but it's limited. Much of the silver used in electronics is too dispersed to recover economically. It isn't sitting in neat piles waiting to be melted down. So supply grows slowly while usage grows relentlessly. That imbalance doesn't need to be extreme to matter. It just needs to persist. Now look at the participants who can't ignore this reality. Manufacturers, a solar panel producer doesn't hedge forever. Achisomi point. They need metal. If supply tightens, they don't negotiate with the market. They secure contracts. They stockpile if necessary. An AEV manufacturer doesn't redesign electrical systems because silver is expensive. They absorb the cost. Defense contractors don't delay projects over metal prices. They pay. This is why industrial demand doesn't respond to price the way investors expect. It's inelastic. That's dangerous in a tight market because when inelastic demand meets constrained supply, price jumps instead of drifting. Now add another layer. Most silver mines don't exist to produce silver. They produce copper, lead, zinc, or gold with silver as a byproduct. That means silver supply doesn't respond to silver prices alone. If copper demand weakens, silver production can fall, even if silver demand is strong. This disconnect amplifies volatility. High prices don't guarantee high supply. Now, look at investment behavior. Most investors treat silver as a derivative of gold. They watch gold charts, inflation headlines, central bank actions. Silver doesn't move on those signals directly. It moves when physical constraints collide with financial assumptions. That's why silver lags until it doesn't. Now, consider the role of ETFs and custodians. It rewards understanding. Don't forget to subscribe and let's move on. By the time pressure becomes visible, positioning is already finished. That's the uncomfortable truth about silver. The moment it feels obvious is the moment it becomes chaotic. That's why the most important part of this story isn't the number. It's the behavior that leads up to it. Look at what happens when scarcity stops being theoretical. Industrial buyers don't hold press conferences. They don't tweet. They don't speculate. They quietly secure supply, lock contracts, and accept higher costs because stopping production costs more. That's when the market changes character. Silver doesn't reprice because investors get excited. It reprices because the people who can't stop buying refuse to be rationed. That's the pivot point. And when it happens, everything downstream reacts at once. Manufacturers pass costs, producers scramble, paper markets strain, confidence fractures. This is why silver's past moves feel discontinuous. It goes from ignored to unavoidable. Now look at the companies tied to silver production. Primary silver miners are rare. Most silver comes as a byproduct. That means the companies most exposed to silver price guarantee control supply in the way people expect. When silver prices rise, they don't immediately flood the market with new metal. Projects take years, permits take longer, capital is cautious after decades of under. So higher prices don't solve scarcity quickly, they expose it. Companies like First Majestic, Pan American, Silver, and Hecla don't suddenly become factories that turn price into output. They become beneficiaries of repricing without the ability to accelerate supply meaningfully. That asymmetry matters. Streaming and royalty companies feel it differently. Businesses like Wheaton Precious Metals or Franco-Nevada don't operate mines. They finance them. Their exposure isn't to cost overruns or labor issues. It's to volume and price. When silver reprices, their margins don't need permission. They expand automatically. That's why, historically, these structures behave differently during metal repricing phases. They don't amplify excitement. They absorb it. Now think about what happens to paper holders. As long as trust holds, claims trade freely. When stress appears, trust becomes conditional. Suddenly, exposure and ownership are not treated the same. That distinction doesn't matter in calm markets. It matters enormously in tight ones. Silver doesn't require everyone to demand delivery. It requires just enough people to remind the system that delivery exists. That reminder ripples outward. Now look at investor psychology. For years, silver has trained people to expect disappointment. False starts, reversals, long periods of stagnation. That conditioning suppresses participation. Low participation creates fragility. When price finally moves, there isn't a crowd positioned calmly. There's a vacuum. That's why moves overshoot. Now, bring this back to how you approached it. You didn't anchor to headlines. You didn't need constant validation. You didn't measure success by short-term price action. You've watched fundamentals do nothing for a long time. You watched demand grow without applause. You watched inventories shrink without drama. You watched paper markets absorb pressure silently. That patience wasn't passive. It was informed. You understood that silver's problem isn't visibility. It's timing. And timing doesn't announce itself early. Now, think about the broader environment. Debt continues to rise. Energy transitions accelerate. Electrification expands. Supply chains reconfigure. None of those trends reduce silver usage. They intensify it. At the same time, capital expenditure in mining remains cautious. Environmental hurdles grow. Grades decline. That's not a setup for abundance. It's a setup for stress. Now ask the uncomfortable question. What happens if silver doesn't That question exposes the flaw. If silver stays cheap, consumption accelerates. Inventories drain faster. Pressure builds harder. Low prices don't solve scarcity here. They worsen it. That's why silver doesn't resolve sideways forever. It resolves violently. Now, consider the number again. $200, not as a target, as a consequence. Achi, that level, Suver, wouldn't he be signaling optimism? It would be signaling constraint. It would be saying that the system finally acknowledged what had been happening quietly for years. That acknowledgement doesn't happen because people want it. It happens because they can't avoid it. Now, look at what people usually do wrong. They wait for confirmation. They chase momentum. They arrive emotionally late. Silver punishes that behavior. It doesn't offer graceful entry once it moves. The calm exists before. That's when preparation looks boring and unnecessary. That's when doubt feels reasonable. That's when patience feels uncomfortable. That's the phase that matters. You didn't need to predict the date. You needed to recognize imbalance. You didn't need certainty. You needed asymmetry. Silver's asymmetry isn't an upside alone. It's in how little needs to change for repricing to begin. A few industrial buyers acting defensively. A few contracts stressed. A few delays acknowledged. That's enough. Now think about what happens afterward. Once silver reprices, narratives flood in. Analysts explain. Media reacts. Investors justify it. By then, the structure has already shifted. That's why the loudest explanations always come last. Silver doesn't care about explanation. It cares about physics, chemistry, and necessity, and those don't negotiate. So when people ask whether silver can reach levels that feel extreme today, the better question is whether the current price reflects reality. Everything you've seen suggests it doesn't. Not because of manipulation stories, not because of conspiracy, but because systems built on convenience eventually meet constraint. Silver sits exactly at that intersection. Quiet, essential, underestimated. It doesn't advertise scarcity. It reveals it. And when it does, it won't ask who's ready. It will simply move. The people who understood this didn't rush. They didn't panic. They aligned themselves with structure and waited for pressure to do what pressure always does. That's not excitement. That's preparation. And preparation is what silver has always rewarded suddenly and without apology.